Good afternoon. I'm Gwen Whistler. I'm the chair of the Finance and Human Resources Committee, and I'd like to welcome you to our October 25th remote meeting. Council members and staff are participating virtually. To help our audience follow along, I'll state each section of the agenda aloud. We're streaming live on our virtual engagement hub, which is accessible through the virtual engagement hub link on the front page of the city's website. We also have an option for the public to listen live by phone. For those of you out there with us today, and I hope there are some, welcome. And welcome to the new kitty cat from Sage's house. For today's meeting, we have the option for people to call in and comment live during the meeting. To call in and comment live, use the same phone number, 855-925-2801, and use the meeting code 5257. Your phone will be muted and you'll hear the meeting live. At that point, speakers will need to push *3 to enter the speaker queue. I'll now go through and introduce all the committee members and the staff who are participating virtually. If you're not speaking, please make sure you're muted. And if you want to speak, either put your hand up or unmute, and I'll try to keep an eye on everyone. So when I call your name, if you just say a brief hello, Councilwoman Sandra Kilgore.
Good afternoon.
Councilwoman Sage Turner.
Good afternoon.
City Manager Deborah Campbell.
Hello.
Let's see. Finance Director Tony McDowell.
Good afternoon.
And is Becky Ogles with us? Oh, yes, she is. So Assistant Finance Director Becky Ogles.
Good afternoon.
Budget Manager Taylor Floyd.
Hello.
And Affordable Housing Officer Sasha Vertunsky.
Good afternoon.
Okay, good. All right. So again, like I said, I'll tell so our audience can stay tuned into where we are. I'll go ahead and give where we are in the agenda. So the first item on the agenda is the approval of the minutes. Do I have any questions or changes for the minutes?
No, and I'll make a motion to approve the minutes.
Great. May I have a second?
Sandra, I'll second.
Okay, great. So we'll do roll call. So Sandra Kilgore.
Aye.
Sage Turner.
Aye.
And I'm an aye also. Okay, so the minutes have been approved. So the next item is the Land Use Incentive Grant, Orange Capital Advisor. And I'll turn it over to Sasha Vertunsky, to Affordable Housing Officer, please.
Thank you so much. And there's some work going on. So can you hear that? No, great. Okay. I think Alicia is going to pull up my presentation, or I can. Thank you, Alicia. So this is a land use incentive request for 110 River Hills Road. Damie Cisse with the law firm representing this applicant is here as well. Next. So just a few key takeaways here at the beginning. This land use incentive grant is affordable housing incentive grant based on the increased value of a development. This application was submitted for about 153 apartment units at 110 River Hills Road. And they are committing to 20% of the units being affordable for 20 years at 80% of area median income or below. And they're also bringing some additional benefits, which I'll be going through. And they qualify for a 17-year grant. Next. So again, it consists of 153 apartments and some community space. They will be a mix of 1 and 2 bedroom apartments with 17 1-bedrooms and 14 2-bedroom units. Housing represents 100% of the rentable square footage, which is part of the requirements for this program, is why we're mentioning that. 20% of the units, or 31 units, will be affordable, serving those at 80% AMI or for a minimum of 20 years. And the project is in about 10.9 acres of land on River Hills Road, and the current estimated taxable value after construction is $36.7 million. Next. So this is the project location. River Hills Road is that road you turn off of South Tunnel if you were going up to Target or Dick's or any of those those big stores there. And this parcel, I think multiple developers have tried to develop this over time. It's got wetlands on the site. It's, it's close to the Shenandoah River. So it's a difficult parcel to develop, and it has topography as well. Next. And here's the site plan. You can see at the top of the screen an area which is the kind of wetlands being preserved and stormwater. So we have a building kind of with parking on both sides. Next. So this is the point summary and how we calculate what points a project qualifies for. So 20% of the units are affordable at 80% AMI, which is worth 20 points. 10% of all the units will accept rental assistance, additional 5 points. They are proposing to house a person from the homeless by name list. Their location gets them 10 points. So they're less than a mile from an urban center, which in this case is the Walmart Center. That's a part of the comp plan and the rezoning that council did last year, or in this past year, excuse me. And then they're a half a mile from a transit amenity. So they're less than a half mile between two transit routes that are on Tunnel Road. Energy efficiency with Energy Star and solar panels, universal design of 20% of the units, and building in a non-qualified census tract is worth 10 points. So the total is 85 points for a 17-year grant period. Next. In vouchers, we've talked about this before, but 50% of the affordable units must accept housing choice vouchers. These help folks at 50% AMI or below, and those folks are coming from the housing authority, and it also opens up a space behind them for, the housing authority also has waiting lists. The last number I've seen, I haven't seen the next, I think this will be updated soon, but with 88 households looking for a place to rent with vouchers right now. So it's slowly going down, but we still need units. Next. So the current parcel has a current tax value of about $500,000. So we're collecting $2271 annually in taxes, and that's just on the land. Using an estimated tax value in the future of $36.7 million, the property tax would be approximately $148,000 a year. And so the difference, because we will continue to collect that $2,200, is $145,882. So we would grant that back to the property owner for 17 years, which gives us a total grant estimate of $2.48 million. And then the subsidy is equivalent to about $80,000 per affordable unit. And then after year 17, the city will receive the approximate $148,000 in city tax revenue again. Next. This went to HCD committee, and it was approved 2-0 on October 18th last week, and staff is recommending approval. Next. And then these are just our key takeaways again. And I would stop there and ask if there are any questions or comments.
Deborah, did you want to?
Yeah, I just wanted to note the 2-0 was because we had one council member who was not in attendance.
Right. Okay. Thank you. Now, so I have two questions, and I think I have been told the answer to this question, but I can't remember. So if the grant is less than the agreed term of affordability, how do we enforce that? So, so we quit giving them a grant after 17 years, but they still need to have the units affordable for 3 more years.
Sure.
What happens if a developer decides that, year 18, when they're no longer getting the grant, that they want to go to full market rate? How do we enforce that?
Well, there's a couple of things. We're monitoring those. Yeah, you're talking about if we know they're not doing it.
Right.
So we're monitoring the units. There's a deed restriction placed on the parcel and on the project. And I believe this is also a CZ, and it may end up in its conditional, it may end up in the B, we don't call them B1, E1 condition list.
Right.
Well,
Okay.
so there's a couple different things. I guess for violating the conditional zoning piece, it becomes a notice of violation. I think with the deed restrictions, I feel like we could almost technically revoke their CO.
Oh.
There's some actions we
Okay.
could take. I don't think we would ever get to that point. We do have a cure process
Okay.
where if we find out someone, they don't have all their affordable units, they have a certain amount of time to cure that condition.
Okay. All right. But I mean, we monitor it somehow and make sure they comply. And then at the very beginning, you said something about 100% of the rental.
Right. So
What does that mean?
So one of the requirements of the Luigi program is that it's a certain percentage of your rentable square footage has to be residential. And basically what that's trying to do is, like, if you had a mixed use project, the policy is set up so that it can't be just 20% residential and you're giving a grant back for a lot of taxes, which are based on retail or whatever else.
Commercial. I see. Okay.
So it meets that threshold. That's really just what that's about.
Okay. I understand. All right. Sage?
Thank you, Sasha. And we talked a little bit about this HCD last week, but I want to mention it again for the sake of the other counselors and whoever may be listening. So one of the things we're running into and we may need to talk about when we look at this is kind of this like valuation structure, right? So I guess can you go back to that valuation period, that slide? Because we're kind of saying it's a range, but this is the cap, right? I want to make sure that's what I understand, right? This is the cap, and when it's built and there's an actual valuation, it may adjust, but it will not go higher than this, the level of subsidy. But what I learned in HCD was that you used to be able to go to the county and request a future value, but that's not happening anymore. So we may need to look at what kind of process to establish this future value. But I think for the purposes of this particular project, we're just looking at it like a cap, right?
Correct. Yes. So if the tax value came in below 36 million, our grant is going to be based on what taxes they actually pay. And it's going to be for 17 years. It's not going to be, oh, well, you didn't get to that 2.48 million. We'll extend it a few years. That's only council could make that decision.
Right.
Okay.
Okay. Yeah, that was it for me. Thank you.
Okay. Any other questions, council? All right. So I assume you want a recommendation to take this to city council? Yes,
please. And Damie Cisse is here. I don't know if she has any comments or not.
Does anybody want to talk to the developer's attorney? We just would like to see Damie. We just see a big D there. We'd like to wave to you.
I was able to.
There you go.
Good morning or good afternoon.
How are you? Does
well.
anyone have any questions for Damie? All right. Well, with that, I'll entertain a motion to move this to city council.
Sandra also moved.
Sage, I'll second.
Okay, great. So let's do a roll call vote. Sandra?
Aye.
Sage?
Aye.
And I'm an aye. Okay, great. And this goes to council tonight? No.
No, ma'am. No, it will be going November 15th.
November 15th. Okay, super. All right. Well, thank you, Damie. Appreciate your hanging out with us.
Thank you all. Have a good afternoon.
Thank you. Okay.
Thank you.
Okay, so the next item on the agenda is item number 3, and it's the CFO update. And I'll turn it over to Tony McDowell.
All right.
Oh, well, I don't know. Am I turning it over to Tony or Becky?
Yes, you're turning it over to me.
Okay. All right.
Thank you, and good afternoon, everybody. And Becky's here for support, but I'm going to try to go through all these slides myself this afternoon. So, and we do have a presentation I think Alicia's bringing up. So the CFO update this month is the same as the CFO update we've been providing you all the last 2 months, and that's an update on where we are with our year-end audit. So, Alicia, you can go to the next slide. So key takeaways from today's presentation is that the process is nearing completion. And I can tell you, Becky and I are both very, very happy about that, as is the rest of the staff in the accounting division here in finance. And we're happy to report to you all that we remain on schedule at this point for completing the audit and submitting it to the LGC sometime next week, sometime the week of October 31st. Not sure exactly the date yet, but it should go in sometime next week. And then we're going to share a little bit today with you all some of the preliminary results related to unassigned fund balance. And I know that's one of the big things that council and management is interested in as we finish up the audit. And I've got some slides to kind of show you all where we think we're going to land, but it looks like we're going to be somewhere between 18 and 20% with our general fund balance, which again is going to align us very closely with our 15% policy goal and kind of where we've been over the last 10 years or so. And we have some charts and data to show you all that as well. So next slide. So the audit calendar, I think you're all probably familiar with this now. I think this is the third month in a row you all have seen this. So just to kind of give you an update on where we're at and what's happened since we last saw you all in September. October has really been about us and Becky's staff responding to auditors' questions and wrapping up that annual comprehensive financial report. And actually, you can go on to the next slide if you want, Alicia. So what October work has included is, like I said, really us kind of at the staff level responding to things and questions that the auditors have. We submitted the trial balance to them back in September. And so they've really been looking at our data and asking us questions. They've been doing testing of our major grant programs, along with our revenues and our receivables, and they've been testing expenses. So there's been a lot of back and forth between Becky and her staff answering questions. They've also been reviewing that final trial balance, and there's been some updated journal entries that we've made, most of those relating to the GASB 87 standard for leases, which I think you all may remember from previous presentations is new this year. So we've been working closely with our auditors on that to make sure we're reporting our leases in accordance with that new GASB standard. And then there's been a lot of time, and this continues right now as we speak, staff working on drafting the notes, the tables, the financial statements, and calculating those fund balances. That comprehensive financial report that we produce is about a 200-page document. So there is a lot of work that goes into pulling that together. And then we're still working on that. And then we've been meeting regularly with the auditors. Becky and I have a weekly check-in with the audit team each week. And so kind of the status I can give you all right now, the status update, is based on our last meeting with them, with the auditors last week. They've identified no material weaknesses to date. If you all remember, in each of the last two annual audits, there have been material weaknesses that related to how we did our year-end closeout procedures. But so far, like I said, nothing that we've heard from the auditors has risen to the level of a material weakness this year. They have identified one, what they call it a significant deficiency. It's a lower class of finding than a material weakness. And we're not sure yet. We're still working with the auditors as we go through the last week or so to determine if that is going to actually be something that keeps it from being a completely clean audit. But we'll update you all on that when we present the audit here in a few weeks. But that deficiency relates to how staff initially reported some of our capital asset entries in the water fund. We worked with the auditors, obviously, to correct that, but some of the initial data that we sent them was incorrect, and the auditors discovered it, and we fixed it. But the dollar value of that correction was about $600,000, and so that level alone triggers this deficiency requirement that they may have to report that to you all as a part of their presentation in a few weeks.
And Tony, have you identified what caused that mismatch?
Yeah, and Becky, please chime in if you'd like. I think we would characterize it as staff error. We have some staff in our accounting division who do our capital assets, and we have a supervisor who reviews those. Both of them are still relatively new in their positions. And so the work that they did, and essentially what happened was they put our capital assets in two different buckets. So at the end of the year, we have to characterize our capital assets as either being complete, a project's complete, so we put it on our fixed asset records, or a project is still in progress, in which case you don't put it on your fixed assets. And we actually put some of those entries in both places. And like I said, the auditors fixed it, but it got through our review here and got to them before it got fixed. So
and how would you fix that in the future? I mean, have you identified procedures to put in place to fix it in the future?
Yeah, I think it's essentially more review on our end, more staff training to make sure that that they understand, the error that was made this time, and so that it doesn't happen again. So.
Yeah, and Gwen, there are actually numbers that we can tie out. I'll be honest, I'm not sure exactly why they weren't tied out this year, but it is definitely something I'm going to go over again with the staff members. So yes, I think it should be a fairly easy fix on our end, and I hate that we missed it this year, but unfortunately it happened, and we will learn from it and move forward. So yes, I think we should be able to fix this very easily. They identified it, the auditors identified it, sent it to me just to make sure that they were reading our reports correctly. And I did confirm that we had made the error, and we did the calculation as to how we needed to fix it, and fixed it within the day. So yes, we definitely know the error, and we'll make sure it doesn't happen.
I'm just wondering, from a standpoint of fixed assets, I mean, the downside would be you'd depreciate too much?
So it wasn't even that. It was actually on some of our easements. It was a really kind of nuance, to be honest with you. Basically what happens is we have a giant spreadsheet that we do our CIP process on, kind of showing what has been capitalized, in previous years, what's been capitalized this year. And basically that number of what was capitalized this year did not make it onto the spreadsheet. So what I have told the two people the girl that does it and then the person that reviews, is that, we need to make sure we're tying out our additions to what is actually on the GL. And I think it was just that simple something that did not happen this year for some reason. So yes, we should be able to fix this.
So really our general ledger wasn't wrong. It was a
no, our general ledger actually was incorrect, because we had it as an addition, but we had also added it as like a CIP adjustment also. So the 600,000 was actually in both buckets. So basically all we needed to do was reduce our CIP. So yes, and we had made a journal entry. So we did have to do a correcting journal entry to decrease our CIP.
It seems like you would have fixed that ultimately. I mean, it just seems like it wouldn't have ultimately balanced. It's like if you didn't spend that money, I mean, that's the lovely part of double entry bookkeeping. So yes. I probably would have found it. But
and yes, no, I think we would have. I think unfortunately they just found it before we did.
Right. Okay. Well, hopefully it doesn't show up, but at least it's not a material weakness.
No, it is not. And we definitely have the processes in place to make sure it doesn't happen again.
Okay. All right. Okay. I'm sorry, Tony. Go ahead.
No, great questions. And thanks, Becky, for jumping in and helping me out there. We can go to the next slide. Okay, so kind of next steps, like I said, we're really in the final week or two of wrapping this up. So staff is reviewing the final draft ACFR, that's the Annual Comprehensive Financial Report that we'll be getting back from the auditors. And then, like I mentioned, we'll be submitting that to the Local Government Commission the week of October 31st. And then our external auditors will be here to present the audit both to the Finance Committee and Finance and HR and Audit Committees virtually on November 15th, and then in person that same night at the City Council meeting. And that will officially wrap up the audit for this year. allow us to move ahead with the debt issuance that we have planned for January, February. And then we will begin looking, and I think I've mentioned this at some of the previous meetings, by policy, after 5 years, we put our external audit out to bid. And so Becky and I will start working on that process of getting an RFP out and selecting a new firm and kind of see what's out there, what the market's like. The policy does allow us, if we do not receive proposals from other firms, we can continue on with the current firm if we want to. But if we have proposals from other firms that meet our expectations, then we will be changing to a new auditor effective next year. So we'll just kind of see what's out there right now. From what we've heard, there's not a lot of firms out there that are bidding on local government work in North Carolina right now. So be interesting to see what the market's like. All right. You can go on to the next slide. So I guess I'll kind of stop there before I go into the fund balance, just to see if there's any other questions or comments. I see Ms. Campbell has her hand raised.
Deborah?
So thank you. I just wanted to thank the staff. As you all know, it's been a tough 2 years for us. We lost some staff in finance, and I just hate that we had this kind of accounting error because Becky and Tony and the rest of the staff have just worked so hard. But the silver lining is no material findings, so that is definitely showing the progress that has been made. But I just hate it for Becky that in particular, because I know how hard you've worked on this particular important financial piece of information that we have to have annually. So thanks for your work. And I just wanted to acknowledge that to the rest of the committee.
Yeah, no, I mean, we really do appreciate, we know how hard you guys work, and you take a lot of, it's hard work and often unsung. So Sage and I really get it that like accountants just don't get celebrated as often as they should be.
And it never ends. As soon as you complete this process, you start it over again.
It just, exactly.
Yeah.
All right. If we don't have any other questions or comments, you can go ahead, Tony.
All right. Well, thank you all very much for the kind words. And it is going to start over. And I think you all, when Taylor comes on board with the budget stuff here in a bit, you will see we're going to be quickly moving into budget process. So, all right. But before we leave last year, I did want to give you all kind of an overview of where we think that the unassigned fund balance is going to end. And again, this is preliminary because there could be some changes before we finalize the report. But just have a few slides, and some of these slides are ones that we showed you all back during the budget process last year, just to kind of talk about fund balance, what's the importance of fund balance, what it is, how we compare to other jurisdictions, et cetera, et cetera. So Alicia, you can go to the next slide. So just quickly, what is fund balance? Well, we're going to talk specifically about what's called unassigned or available fund balance, and that's money that's left at the end of one fiscal year that can be appropriated to pay for or finance expenses in the following year's budget. The North Carolina Local Government Commission, I think as you all know, has a minimum policy that they require all local governments in North Carolina to maintain at least 8% unassigned fund balance. Most jurisdictions, and we have a slide with some comparative data that we'll show you all in a few minutes. Most jurisdictions in North Carolina maintain fund balances that are well above that 8% threshold. Here in Asheville, we've had for a very long time an internal policy that we maintain a fund balance equal to 15% of our expenses each year. So next slide.
But Tony, just to clarify what you just said, most of those other cities, towns, et cetera, that have much higher than 15%, it's because their total their expenditures are so much less. So, 15% of our expenditures is a lot of money versus, if you talked about Black Mountain, 15% of theirs really isn't, it doesn't compare dollar to dollar. So, I thought that our 15% looked pretty good relative to other cities our size. Is that right? Or
Yeah, you're totally right. And yeah, most smaller jurisdictions, just because their budget is smaller, they'll maintain a fund balance that's 100% of their budget, 200%, something like that. Meanwhile, a larger city like a Charlotte or a Raleigh, they can get by with a smaller percent because it's just a bigger dollar amount. But yeah, that your comment is absolutely spot on. Okay, so why is fund balance important? For a couple reasons. One is it helps us with our cash flow management. Our property tax revenue, which is the main revenue source in the general fund, typically comes in a big chunk in December and January each year. So there's months, actually we're kind of in those months right now in October and November, where there's not a lot of cash coming into the city. So having a fund balance kind of helps you smooth out that cash flow that would otherwise be really uneven throughout the year. It's also one of the key fiscal health measures, if not the most important key measure of fiscal health. And it can really tell you if you see a fund balance, for example, that's declining, it's a good indication that local government is kind of spending beyond their means. And so you want to see a fund balance that's stable, that's not decreasing dramatically or increasing dramatically either. It's obviously a factor in determining our credit rating. Standard & Poor's and Moody's both look at our unassigned fund balance as one of the factors that they consider when they're giving us our credit rating. And it provides a financial resource to help weather unexpected crises. Probably the best example there is kind of natural disasters. And so, for example, communities down near the coast, like Wilmington, often maintain a much higher fund balance than other places, simply because they need those resources in case they have a disaster or hurricane or something like that. So next slide. So when can fund balance be used? So essentially, council must approve fund balance usage. So each year when we adopt the budget, or if there's a budget amendment that we bring to you all, that's the only way that fund balance can officially be taken out and used, is by you all approving it. Obviously, the fund balance can go up or down year to year, and you're going to see that in a few moments here when I kind of talk about our results for last year. But that's really based off of how we actually did, how expenses compared to revenues. And so if we had expenses in a given year that were higher than revenues, you could see fund balance actually decline. But typically that doesn't happen. So, and it didn't happen last year, which is a good segue into my next slide. So this chart is one that we showed you all back during the budget process. And it kind of gives you an overview of where our fund balance has been for the last 10 years. And so what we did with this was we updated it to show the preliminary number for fiscal 22, and then also how that 22 number translates into 23 budget numbers, because obviously we adopted a budget in 23 that was higher than our 22 budget. So we wanted to give you all both those numbers for comparative purposes. But you can see fund balance for fiscal year 22 looks like it's going to end somewhere around 20 to 21%. And then when you take that same number and you compare it to what our budget is in fiscal 23, it's somewhere around 19%. And so you can see from this chart, again, going back to fiscal year 2012, and this was a point we made during the budget process as well, is that we've really been very successful at managing our fund balance within that kind of narrow band between 15 and 20%. And so I would say, kind of the takeaway from this is that our fiscal year 22 results are very much in line with where we have been for the last 10 years or so. So we're very pleased with that.
So Tony, where does the 20.9% land relative to when we set our budget for 2023? What were we guessing it was?
So,
I don't remember it being above 20%. I was thinking we were at like 18 when we were estimating for going forward. But
yeah. And I don't remember exactly what our estimate was. I don't know, Taylor may have that in front of him, but I'm not going to put him on the spot and ask that question. But I think you're right. It was somewhere around 18%. We did not estimate it was going to be this high.
right.
And I've got in a slide or two, you'll see we have
It was probably sales tax, wasn't it?
It was exactly. That was really the biggest driver, was that sales taxes ended up much, much stronger than we had anticipated. And so that was really the key factor in driving it up from what our initial estimates were. So, All right, Alicia, you can go to the next slide. So again, just to kind of compare us to some of our peers across the state, and this is some of the same data we showed you all during the budget process. We didn't have updated numbers for fiscal year 22 for these other cities, so all the numbers on here are still fiscal year 21 for everyone but us. But we wanted to kind of show you all again kind of where we fall in terms of our policy, as well as our actual fund balance. And you can see we're kind of in the middle. So from a policy perspective, again, we require the minimum of 15%, and you can see there's a range. In fact, there's quite a range from a Greensboro, which is down at 9%, up to a Concord, which is at 30 to 35%. But most folks are kind of in that middle range, kind of the 15 to 20%, 25% range. And you can see in terms of what folks' actual fund balance is, again, we're showing ours at 19% compared to the fiscal year 23 budget. And there's a range there as well. Again, Greensboro down at 10%, all the way up to a Concord, which is at 50% of their budget. So again, we're kind of right in the middle of where most of our peer cities are. So next slide. So again, kind of back to this why question. How did we end up with our fund balance at 20%? And Councilmember Whistler, I think you again hit upon the biggest factor in that was that our sales tax growth last year, and we talked to you all a little bit about this at your last meeting, that sales tax revenue was up 17% last year, which is the highest increase we've seen in many, many years. And that's on the back of a 16% increase in fiscal year 21. So we've had two really good, kind of unprecedented years of sales tax growth back to back. And that's really what drove fund balance up to be slightly higher than we had estimated during the budget process. But again, we feel like at this 18 to 20%, that really positions us well financially right now, especially given kind of the current economic uncertainty that's out there and the heightened risk of recession that we're hearing about as well. So.
Sony, could you go back one slide real quick? I assume this is coming to council as well. Can this either be sent to us in Excel? I want to resort these by total expenses. I'd like to investigate these numbers more. Maybe we can have it emailed to us or something, so I'll have to type it all over again. But it's interesting how some of these cities that are doing 15% or 14% have much higher expenses. I guess what I'm ultimately getting at is if we were to drop to 15%, I'd like to know the dollar value of that.
Gotcha. Yeah, we can definitely send this out and in that format and do that calculation for you as well. So. All right, so I think we can go to the last slide. And that's really all I have. Again, the key takeaways, we're really close to being done with the audit. We're going to turn things over to Taylor and let him take the budget from here. And we're pleased with where we are ending the year with fund balance. Again, I think it really positions us well going into the budget process this year and any potential economic downturns that we might be facing. So thank you all for the time and happy to answer any questions.
Tony, for tonight's presentation, could you do one thing for me and add? So our credit rating got upgraded, I don't know, 6 years ago, maybe. I was on council when it happened. It was very exciting. Can you, just on that slide that shows what our fund balance was doing, can you put the year that we got the increased credit rating?
Yeah.
When that got, I just for curiosity and I mean, just to kind of highlight that that fund balance really does affect our credit rating. And that's why we are able to borrow money at lower rates. Well, borrow money and at lower rates.
So this presentation itself won't be done at council tonight.
Okay.
The Q1 presentation that Taylor's doing will be, but we can certainly, when we come back on November 15th and the auditors do their presentation, we can include some of these slides and information with that presentation.
Yeah, I think it's good information because it was very exciting when it happened.
Yeah.
that it for your presentation, Tony? Because I
It
have a
is.
question, but it's a little bit of a non sequitur. It kind of ties to our previous item. One of the things I keep bringing up in HCD, and I think Sasha's going to help tag team this, is how, as we do so many of these Luigi's and we do so many of these HTF loans, how is that going to play out in decades future budgets, right? Because I'm kind of looking at like when money cycles back around. And I don't know if that's something that should maybe be in your department or something. So I was just bringing it up because I think that's going to be really helpful to us as we look down the road at like, I don't know, maybe in 2024, maybe we do bonds, affordable housing bonds or something, but do we need to? Or, are funds cycling back into it? I think that's going to help us with our long-term planning. So just mentioning that.
Yeah. Yeah, I think that had gotten passed on to us. I think we're working
Okay,
we're
great.
working on providing you all something at your November meeting. So
Thank you.
All right, Taylor, take it
All
away.
While Alicia is pulling up our presentation here, hopefully, there we go. All right. Good afternoon, council members. Again, just a quick kind of high-level overview of where we are at so far after the first quarter, which ended September 30th for fiscal year 2022-23. Next slide. So briefly, we're just going to hit revenues and then expenses, both personnel and operating. We'll touch just for a moment on business type activities in the general fund, which are the Nature Center and Aston Park Tennis Center, and then kind of some summary and next steps. So next slide. I think that what you'll hear me say probably quite a few times are these bullets here. It's still really early in the fiscal year, and we are missing, or we just don't have yet some really key data that will kind of help us better forecast where we'll end the year. But what we have so far, both on the revenue side and the expense side, leads us to that we are spending, revenues coming in as expected and spending is occurring as expected as well. Next slide. All right, so starting with the revenues, we just wanted to kind of give you a little bit of a refresher here. This is general fund, current year adopted budget revenues. Key takeaway, as always, is that property tax and sales tax are overwhelming majority of revenue in the general fund, over 75% of our budgeted revenues. So we'll focus on those two here. Next slide. As you all are aware, Buncombe County and HCA reached a settlement after, I think, a few years on an ongoing property tax value dispute. Part of that settlement, or as part of that settlement, they're going to refund some prior year payments to HCA, and that's actually going to be deducted from their current year tax bill. So what that means for the city of Asheville is that we're going to see a approximately $483,000 deduction in our, or reduction, I should say, in our property tax revenues. And while I don't want to undersell the impact of an almost $500,000 revenue that we are expected to receive but will not be receiving, we do think that we're still likely to be on target with our budget projections as it relates to property taxes due to growth in our property tax base. So renovations, new building, that kind of thing. We get that information from the county tax office. I think rightfully they conservatively estimate what that growth is going to be every year. So we expect that that will again still come in on budget on property taxes. And for some context, again, $483,000 is significant, but it is under 0.6% of our total property tax budget, which is about $81.4 million.
And Taylor, on an ongoing basis, so the 483, does that represent 5 years, 2 years?
I'm not sure. I want to say it's less than 5. Pretty confident about that. I don't know, Tony, if you have an answer to that.
Well, I think the deal, I mean, that transaction occurred about 3 years ago, so it probably is about 3 years. So really on a, if you divide the 483 by 3 on an ongoing basis, it's not really a ton of money.
Right.
Okay. Thank you.
However,
Sage, do you have a question?
I'm just pretty upset about this. I'm disappointed. So I guess when I wasn't on council when this deal was happening or anything, but I remember looking into it and reading in other cities that they had done this, perpetually fought down the valuation to reduce their property tax leverage, meanwhile posting like billions and, net profits and stuff. And so, I mean, I guess what I read in the paper is all I know about this. And so it sounded like our team, our legal team and their legal team perhaps were trying to negotiate this. This is we came to a settlement on this. And I guess my question is, do we know if this is going to keep happening or?
I think since the settlement has occurred that like the values have been established and mutually agreed upon, I guess, for lack of a better term. So I think going forward, barring any, again, new equipment that they purchase or renovations or expansions that they do, the value will remain the value until there's a new valuation that
this is as rock bottom as they can push us, basically. Okay.
Well, and this isn't something that the city would have been involved with.
I know. Well, I thought
because
that
it's Buncombe County. Yeah, but Buncombe County is, the one who deals with valuations. And so it was probably really led by Buncombe County as opposed to the city.
And I was just going to add 2 quick things. One is the 483 represents 2 years of value or taxes rebated to them. And then kind of to your point, Councilmember Whistler, this was the settlement was negotiated between the county and HCA and the Property Tax Commission. Our folks on our side were not involved with that. So.
Still very disappointing. Thanks.
Well, and then on top of it, they usually brag about, they usually say, and, we contribute all this money to the city for property taxes. It's like, yeah, and fight it every way you can get there, but whatever.
Yeah, certainly, again, not ideal, but we expect that we will still at least, not be a major impact on our property tax revenue overall. Next slide. So Tony hit a little bit of this already, but we have only received 1 month of FY23 sales tax data from the Department of Revenue. We actually got that, I guess, last week, or maybe it was the week before now. Good news, I guess, overall, July 2022 sales tax revenues 8.5% above July 2021. Again, as Tony mentioned, for the fiscal year last year, we saw growth 17% higher than the previous year, which is pretty substantial. And, just for kind of a comparative, what we would say is typical in a growth year. And I do want to say that growth in sales tax is not a guaranteed. It does go down sometimes, but typical growth we would estimate somewhere around 5%. So pretty substantial increases. But we do see, some economic uncertainty and interest rate increases. The Fed is likely to continue. That's probably going to temper growth in the current fiscal year. The other thing I do want to point out is that, again, while 8.5% is pretty substantial, some portion of that is related to inflation. So obviously, as the cost of goods and services goes up, the percentage, the taxes paid on that are going to go up as well. And we're seeing similar challenges in goods and services that we're procuring from an inflation perspective. So I guess on one hand, good that we're keeping up with that, but I think it's not 8.5% kind of just growth. I guess I'll put it that way. Next slide. We did want to touch on the parking fund. We had a lot of discussions around parking, especially their revenues last year. And so we wanted to give you all an update there. Good news, revenue, especially from the parking garages, but the meters as well, are performing as expected and in line with budget. We're seeing significantly better revenue than last fiscal year. And while our garages are in line with pre-pandemic budget performance, they are under pre-pandemic actuals. And I'll try to unpack that a little bit because that's not super straightforward, but hopefully I can explain it succinctly. So last year, our first quarter garage revenue, so this is just for the garages, was 7% of budget, which is obviously well under what you would want it to be. This year, it's 27%. And for, again, kind of a comparison pre-pandemic in FY19, it was 24%. So we're right there pretty close with how things were performing relative to budget before the pandemic. However, if you look at the actual dollars that have come in, first quarter total revenue, again, just for the garages, is around $800,000 compared with $1 million in FY19. So again, we're still under from an actual dollar level where we were seeing things pre-pandemic. But again, to compare to last fiscal year, we had brought in $300,000 in the first quarter of last fiscal year. So again, a substantial improvement over last year and kind of seeing performance as anticipated or as expected, I guess I should say, relative to what we budgeted.
Sage?
Yes, ma'am.
Yeah, we don't really have like a parking committee or something, so I assume this is the best place to mention this, but I'm just wondering if we could start getting some more detail on these revenues. There used to be a subcommittee of the Downtown Commission that would look at charts and graphs on parking, because I'm getting mixed signals. Like I had a local business, the Federal Building, some officers in that building had requested if the city had any available parking, and I followed up with the parking department and everything. And what I learned was that our wait list was handwritten, and there was no technology, there was no email thread. I'm just wondering if there's like some things that we could be doing to look closer at this revenue stream and how it's structured to make sure it's implementing and moving smoothly. Because, keeping a hand list and phone calling everybody on a wait list to get a parking space and a deck seems really old-fashioned. And it's not helping, or, it's not being addressed. So I thought I'd share. We don't have a place to share this, so I thought I would here.
Sure.
Deborah?
So for this committee, and we can do this when we have the report this evening at the council meeting, Ben Woody has been assigned. Transportation is under his portfolio. We are working on modernizing, updating, getting the kind of information in a format that is readily accessible. And so we're working on it, Sage. And
that's great.
If you give us a couple of months, and Ben, I have it.
That would be awesome.
And I have it together, particularly before we go through the next, budget cycle.
Okay, that's great. I love that Ben has that skill set already. Because as we see it starting to impact revenues for transit, we really got to look at how fumbling in this department might really hurt others.
Yes, ma'am.
There aren't any other questions on parking. I think we can move to the next slide. So wrapping up on the revenue side, did want to make mention ABC revenue. So we have a kind of revenue sharing arrangement with the ABC board. For last fiscal year, came in almost $900,000 higher than the previous fiscal year, which is a pretty substantial increase. We did reach out to the general manager, and he let us know that he thinks that kind of growth is unlikely to continue in the current year. Again, as I said, you're going to hear me say inflation a couple more times. They're seeing personnel cost increases, and then of course, their, I guess, wholesale, cost of the goods that they sell going up as well. So again, he did not anticipate that would continue at that rate into the current fiscal year. So to summarize, first quarter general fund revenues, 6% of budget. That may appear alarming, but again, as Tony mentioned earlier, most of our revenues coming from property tax. Most folks don't pay their property taxes until they are considered late in January. So we get most of that revenue in the second and third quarter. So again, as expected there. And then in the enterprise funds, we kind of see a little bit of a range, most right around that 25% mark. The two that I would say are not, one that's at 1% is our street cut utility fund. And that's actually billed out based on actual expenses quarterly. So they just sent their bills out. They're actually already over 25% now in October. And then stormwater, a little bit under that 25% mark as well, but they have some commercial accounts that aren't billed on a monthly basis. So again, as we would expect, those revenues aren't coming in kind of right along with as the year progresses. So if there aren't any other revenue questions, I think that we're going to move to expenses.
Sage?
One real quick. The ABC revenues net goes into general fund, or is it enterprise?
Yes.
Okay. So I just read, I guess it was in one of Gwen, your committee, I guess does this. It was an update, a presentation where one ABC store, the one on Charlotte Street, was like the most profitable, did like 12 million gross sales and netted like over 2 million. And I'm curious if it looked like in those applications for the chair of that board, we heard some of what that board might be thinking about with that revenue stream, but I had a couple conversations around like what could ever happen. It's going to feel so random, y'all, with the South Charlotte Street property and our redevelopment. We did that relocation assessment and so on. But can we ever earmark funds from like, if this one ABC store is just kicking butt and making that much money, can we earmark some of those for the relocation over time of those services so we can start getting that land going? Or is that like way outside the norm of what's allowed? I mean,
well,
really,
so Sage, so as you know, I'm the liaison for the ABC
I've learned
board.
so much. Oh my God.
And what they, so the reason that store has profits like that is because that is the store that services all of the restaurants.
Right.
And net income for restaurant sales is higher than for retail sales. Okay, just the nature of the anyway. So ABC did come to the city and ask that they would expand the South Charlotte Street store so that they could more effectively service the restaurants, for lack of a better. But the city, because they have plans for the South Charlotte Street, was willing to extend. Right now, they're on a month-to-month on that store. And the city was willing to extend the lease for a period of time, but not long enough that the ABC board felt that would justify them putting a bunch of capital into that building. So what they're planning on doing is expanding their Cherry Street location and changing out their Cherry Street location. So that location will service the restaurants
and start becoming more profitable. Okay.
Yes. Well, right now it doesn't do really anything. I mean, it's kind of just a warehouse in and out and doesn't have sales. Yeah. But
I guess my overall point here is that I just learned that this ABC, these stores are like making a lot of money, and I didn't realize it was general fund, which, is then again up to our discretion in the overall budgeting process. But I just wonder if we might want to be a little more intentional with some of this and like be strategic, as I see them planning for expansions and stuff. It's just a little outside the box thinking about this revenue source I didn't realize was so strong. Yeah.
Well, it is a separate entity. So, they have their own board. They're regulated separately. So I don't know that we as a council, whether
influence their planning
or legal. Exactly.
Right.
But, I do think, I've been saying like the whole time that I've been liaison is I really think that council needs to understand the ABC process a little bit better. Cause it's not 20% of our budget or anything like that, but it's not insignificant.
It's not, especially when we see groups like, I'm sorry.
Yeah, no. And, like if that were privatized, the city would be saying goodbye to about $3 million of revenue.
Right. Well, it
And
strikes
that we
me that-
basically don't do anything for.
Mm-hmm. And it strikes me that these inflated revenues, these gross larger revenues, are because of the restaurant community. And, you know, on the sideline here, we've got the county asking the TDA for money to help build housing for restaurant workers. And then we've got AIR working with affordable housing developers to develop a team, a nonprofit to maybe start. I mean, like, I just wonder if we should be talking about this revenue stream a little more creatively. That's all. I'll leave it there.
Now we'll just point out, that, since it is general fund, we are using those revenues right now to support the cost of, a variety of services that we provide in the general fund. So, earmarking it would perhaps come at the expense of something that we're currently doing. Okay, so next slide. And again, I think we're moving over to the expense side. Again, a current year adopted general fund budget on the expense side. And I think as we typically say, the big takeaway here is personnel related costs are our most significant expense at about 62% of the total in the general fund. Next slide. So on the personnel side, actual expenses are tracking our budget as anticipated. Just as a reminder, we did make some adjustments with the start of the fiscal year in July. We increased the minimum salary for full-time employees to $35,360 annually, and provided most other staff with a 5%, or if they were hired more recently, a 2.5% increase. We do have some additional changes planned for the current fiscal year. In January, we're going to increase that minimum salary to $36,816 annually. And then we also have a consultant that is assisting us with an analysis of compression so that we can make some adjustments related to that. We've, kind of increased that minimum salary several times over the last few years, and trying to make sure that, we're, again, alleviating as much of those compression issues that we've created as a result of that as we can afford to do, essentially. Next slide. And Shannon Barrett, HR Director, I think more or less gave all of this information to you all back in August, but I wanted to share it again. We have made some adjustments to try to, recruit and retain staff in the police department. We changed an advanced law enforcement certification to a 5% ongoing supplement from a one-time 5%. So again, they were just getting that one time once they received that certification. Now it will be an ongoing supplement. We added a hiring bonus structure for both current employees that refer new candidates or new hires that need training, and also certified officers. We're providing relocation assistance, additional leave to both new hires and current officers. And we believe that we can absorb these additional costs based on some updated assumptions around their current vacancies. So they saw some additional vacancies that we didn't plan for back in the spring during the budget process. So again, we think that they can absorb most of these costs. Next slide. So on the operating side, again, inflation is still a big concern for us, but so far we are seeing expenses trending within budget. Did want to make mention of transit service. Again, we talked at length about that during the budget process. We do still have one service interruption in effect due to the driver shortage. That is a reduced frequency on one route. I think it's hourly instead of twice an hour, I believe is the change there. But again, we are seeing the cost of that service, which is primarily through our management company contract, is kind of tracking the budget again, as we would expect. I did also want to make mention, council approved a new management arrangement, I guess I'll say, at the municipal golf course. Those folks, I think, are getting underway now. They're planning to do some work to the course and some of the amenities. And in the new arrangement, we have a profit sharing, revenue sharing model. So there is a potential that, as if we had a, really cold winter, and as they're making some, shutting down the course from time to time again to make those updates, where we might have some months where we lose, we don't make any money. So we're not sure what that's going to look like because there are a lot of factors at play there, but we did want to bring that to your attention. Next slide. And we want to hit on our business type activities, the tennis center and the nature center. We just did a look back at last year, and for Aston Park, their expenses were $126,000 over their actual revenues last year. That is about revenues about 52% of expenses, and then for the nature center, expenses $339,000 over revenues there, which is about 78% revenues to expenditures.
Is this this isn't a normal trend, is it?
So we haven't provided, before the pandemic, I think provided more regular updates on these two facilities to the Finance and HR Committee. I think it has been since pre-pandemic that we've done that. I did go back and look, and the Nature Center had a 25% subsidy goal pre-pandemic. So they're, I would say, on target with that. I was not able to quickly locate a target for Aston Park, but in the last update that we gave to Finance and HR Committee, it was closer to 20%. So that is a bit of a change.
Yeah. If I recall, we tentatively were going for, the 25% subsidies for both of them. But frankly, we ran into a bit of a buzzsaw at the tennis center. So this is not going the right way. And that community,
what's the buzzsaw? What
pushes back a lot on any sort of expense reduction or fee increases. So that's the issue. I mean, the Aston Center is not going the right way, and hasn't been for a couple of years now. But
well, now we have the pickleballers in play, and I know they've had some problems with the nearby park and some actions around there with the youth planning and tennis. So there have been some issues, but my goodness, I didn't realize we were subsidizing to this.
Oh yeah, it's a lot.
I wonder if the pickleballers could supplement.
The Nature Center, the Nature Center, especially the partnership with the Friends, has really helped. And it would be great if we had the same kind of, something like that with the tennis group. But it has, when we've tried to make some operational changes, it's been difficult to implement.
Okay.
I will also say again that we haven't, looked closely, excuse me, at the, we tried to not increase fees through the pandemic. And I think that is especially true in the tennis center's case, which probably wasn't open for a large chunk of the pandemic. But we have seen some pretty substantial increase in especially personnel costs from, again, FY19. So that's probably something that we might want to look more closely at. In addition, both of these facilities are, in a manner of speaking, under new management as part of the new department, which I'm not going to try to say what the acronym is because I'll probably get it wrong. I think it's Community and Regional Entertainment Facilities. Still learning that one. But I expect that again through those opportunities that that department director Chris Corral has with sponsorships and that kind of thing, that we will probably see some improvement. Not to put too much pressure on Chris.
But if he's on this, that's what I was going to ask next. Is this part of Chris now? Because he'll write this ship. It's good.
That's what we're hoping for.
Yeah, I don't want to interrupt this, but I do want to hop back one side and say one thing real quick because we just kind of glazed over this. Oh, one more. We just said it real quick, but I really want to make sure that staff hears how appreciative I am of this slide. We've been having ongoing problems with restaffing our police department. It's not just Asheville and so on, but some of the things that communities around us were doing, some of these incentive programs we were not doing, and we don't know if it was impacting our ability to recruit or whatever, but this is a big step. And so I just didn't want to go by with it just like real quick, because I really want to appreciate y'all for taking these actions and working on this. And I'm really hoping that it helps.
And Gwen, if I could respond, and this is a phase one. We've only just begun because we know it is the market for law enforcement officers is so competitive. Now, we're not going to be irresponsible, but what we are going to do is try to look at, in addition to, and Ms. Kilgore can speak to this in terms of the Public Safety Committee meeting, we had an update on EPIC and EPIC recruitment initiatives. So we're doing very, very strategic, targeted research, data gathering, market analysis assessments, and working with the chief of police, who was saying, Deborah, this is a great start for us. So again, it's not all, but it's a good start. And we work with finance, we work with HR to get here. And they're paying for it all out of their existing budget. But I appreciate you saying that, Sage.
Thank you. All right, so I think we are to the summary. If we skip forward one more. Okay, so again, overall, things are looking as we would expect, revenues and expenses tracking budget, but it is still very early in the fiscal year. One thing that I did want to note is that we will continue to monitor through the year to see if we end up needing to utilize the ARPA appropriation that we did, which was a little over $2 million in the general fund and $300,000 in the transit fund. And again, if our actual revenues come in such that we don't need to utilize that, or not all of that in either instance, we will certainly look to, hold that back so that it can be utilized for alternative uses. I did want to also make note, you may have noticed there is no information on capital projects in this presentation or in the actual report. We had initially intended to provide a presentation on our CIP process to this committee and have our financial advisors give an overview of our debt model today, but with the December 13th council work session scheduled around capital, we're going to kind of hold that all for that conversation together. So we'll review that information at that point. Again, looking forward, we'll have our second quarter report presented in January, I think, the 24th. And then looking a little more forward to the budget process, I think that we will see personnel costs as a significant factor in our budget development for next year. I think we've mentioned in the past that we've had really good performance in our health fund. Health costs have not increased at the rate that a lot of other folks have seen, but we're likely to be in a position where the employer and perhaps employee contributions are need to be increased for that. And then, of course, again, as we're seeing inflation, housing costs, et cetera, rise nationally and locally, likely that we, will be looking at increases from a salary perspective as well. And I think that is all I have. So if there are any more questions.
Council, do you have any questions or comments?
Just my usual plug to try and budget for updates to the guidelines for downtown and the UDO.
And I will apologize to you all in advance that you'll get to hear all of this again in a few hours. So sorry.
That's okay.
We can't wait.
I won't ask all those same questions.
Right. Okay. Well, if we don't have any more questions or comments, I'm going to go ahead and move into the next item on the agenda, which is public comment. We have not received any public comment prior to the meeting, and I'll check with Alicia to see if anyone is in the queue that would like to make a public comment.
Nope, there are no callers in the queue.
Is anybody watching? So sad. Oh. The little kitty's watching. That's right. All right. Well, with that, ladies and gentlemen, I remind you guys that you need to be at the council members. You need to be at City Hall at 4:00. My husband is taking the picture, so be cooperative.
Do either of y'all have your City of Asheville mask? I just wondered. I suggested this photo for historical sake. Like we never really got a group photo. Before we lose Gwen, we needed to, but do we need one? I mean, like the year that council all had to be masked up. It's just a thought, historical purposes,
But our pearls, maybe. Okay, well, we'll see how that'll go tonight. But be on time. Don't give Lee a hard time. All right. So with that, I'll adjourn the meeting. See you tonight.